Welcome to the REI Diamonds Show with Dan Breslin, your source for real estate investment jewels of wisdom.
Welcome to the REI Diamond Show monthly market update episode for this current month of October 2017. I'm here with our resident expert economist and wealth advisor, Paul Sloate, founder of Green Drake Advisors based in Wayne, Pennsylvania. If this is your first time joining us here on the REI Diamond Show, or if you are one of our returning loyal listeners, welcome to the show. Every week, I invite a real estate expert from somewhere in the U.S. to share their wisdom as it relates to real estate investing. If you're interested in checking out our catalog of shows or interested in receiving an email when the next weekly episode is released, sign up at www.reidiamonds.com. You'll even get a free download of my book on wholesaling, basically my business plan. It's called Become a Wholesale Real Estate Master. It's 175 or so pages of all content, no fluff, and I'm not selling any mentorship programs, packages, tapes, or CDs. In addition to our weekly expert guest format, once per month, Paul Sloate joins us here on the show and fills us in on the economic forces at work in the national and global economy and what those forces are expected to do to local real estate investment markets in the short and long term. Once again, single-family real estate remains strong, but there's also going to be some positive economic impacts that came as a result of the recent run of hurricanes and some other bubble proportion markets or micro markets that you'd want to keep an eye out for, at least be aware of if you are not invested in those markets. Let's get right into it, shall we? All right, welcome to the show, Mr. Paul Sloate.
Well, thank you, Dan. Glad to be back.
We are, for posterity's sake, October 12th, 2017. How are things on your end there, Paul, in Pennsylvania?
They are good. We've had what I would call Indian summer in October, Dan. It's been in the 80s, which is pretty hard to believe for October, so it's been really, really warm. But, I'm sure that fall will come, and when it does, it will come with a vengeance.
It's funny that you say that. I mean, Chicago, we've had, I'm sure, much, much, much colder Octobers, but this month it's been beautiful out here. We're talking 75, 80, and the trees are changing, but we're out there in shorts and short sleeve shirts. So it's been a good fall so far, but it is what it is.
It is what it is, and we know it won't last.
Nothing ever does. All right, Paul. Do you want to take the floor and give our listeners here some of the insights you've noticed over the past month or two in the economy?
Yes, I do. And so why don't we talk about what's gone on in the economy? And what's going on in the economy is that the Trump administration is beginning to have an impact on economic growth. If people haven't noticed, they should have, that economic growth has accelerated. Economic growth was over 3% in the second quarter, and economic growth before the hurricanes came through in Texas and Florida was projected to be 3.5% or better for the third quarter. Now, the hurricanes will likely take 1% or more off of the economic growth in the third quarter. However, and this is a big however, that will be made up by the spend to fix everything from the hurricanes. The estimated damage from the hurricanes is $100 billion or so in insured damage. Now, understand that this does not include anything that the individual insurance companies exclude, like flood damage. Flood damage is covered by the federal government, and that insured damage would be in addition to the $100 billion to $110 billion that the private insurance companies are expecting to cover. So once that starts up, we would see that as a mini infrastructure program for the country, as this money, which has basically been sitting in bonds, is now deployed into capital in the economy. So that's one thing we should realize, that one, the economy is growing faster, and two, once the hurricane rebuild starts, it will accentuate this growth. Three, under the Trump administration, they are encouraging foreign companies to actually build plant in the U.S. as opposed to export goods from their home markets. We can see this in companies like Foxconn, which is going to build a $10 billion LCD plant in the United States for Generation 10 or Generation 11 LCD glass for TVs and other devices, as well as companies like Samsung that's going to be building white goods plants to produce washing machines and dryers for clothes, or other companies that have been encouraged to build plant in the U.S. Now, this is really important because manufacturing has a significant impact on productivity growth. And if you have more manufacturing, you have more productivity growth. And if you have to need a cure for insomnia, you can read the numerous economic studies that show that capital spending and productivity are highly linked. Unfortunately, since 2000, the U.S. has not had capital spending in manufacturing, but that's beginning to change, and it's beginning to change in a big way that ultimately will accelerate long-term U.S. economic growth. And the reason I bring this up is that typically with higher rates of growth, we have higher rates of inflation, and we have higher interest rates. And the higher rates of inflation may come before the capacity and the growth benefits from the plants being built here, because there are numerous products and areas where there has been no investment in the U.S. to increase capacity in over a decade, and we need to do it. Give you a simple example, insulation. There have been no additions to capacity since 2005 in the United States. The industry is currently running at 91% capacity utilization, is expected to go to the mid-90s next year. This will likely lead to further price increases as capacity utilization increases, and even if they were to agree to invest large pools of money into capacity today, it would take 18 to 24 months until any incremental capacity could come online. We'll take a look at OSB. OSB prices have gone up because it's been very tight. We do have some capacity coming on over the next 6 to 12 months. That will likely pull prices back for a short period of time. However, and this is a big however, with housing starts at only the 750 to 800,000 level and needing to get to 1.2 million by the time housing starts get to 950,000 to a million, we will have chewed up all this incremental capacity and will need to add more capacity on top of that. Let's take a look at something like steel. Trump administration made it clear to China that they could not dump their excess capacity in the United States. So what did the Chinese do? Even though the U.S. has not officially imposed tariffs, they shut a bunch of capacity in China and increased capacity utilization in the industry. This led to higher prices in China for domestically manufactured goods, and these higher prices made it uneconomic to put it on a ship and ship it to the United States. So prices for steel have gone up. There's another factor in steel. It's something called the electrodes, graphite electrodes that go into the electric arc furnaces that make much of the steel that is manufactured today. The Chinese had significant overcapacity in these electrodes, which they were dumping on the world market. They also cut capacity there significantly to bring it into balance in China. Well, all of a sudden there was demand around the world for the remaining capacity, in the electrode plants in the U.S. and Europe and elsewhere, which those plants cannot meet because they have not added capacity in almost a decade. So prices for graphite electrodes are going up, and that's putting cost pressure on steel manufacturers who are raising prices and putting surcharges in place for the graphite electrode price increases they are facing. So what we are starting to see is goods prices go up in the economy, and we expect this to accelerate, especially if the Trump administration addresses much of the domestic content issues that exist under the NAFTA. So we're going to get a push on inflation, and the one thing we know is if inflation goes up, interest rates will go up. And then the other thing we know is if inflation seems to be getting out of control, the Federal Reserve will act to do something about inflation. So that is something investors should keep in mind. If inflation accelerates next year, the Fed should act, and that might end up with a less than desirable outcome in 2019. Now, let's talk about what we see going on in real estate, and we're going to talk about the self-storage industry as a microcosm of what we've seen going on in housing and in multifamily. So what's gone on in self-storage? It's been a great time to be in self-storage. Starting in 2010, the industry began to recover and had a strong recovery through the end of 2016. In fact, same-store NOI, net operating income, grew at almost a 10% compound rate for the last 4 years. And margins are high and people are making lots of money in self-storage. That's the good news. What's the bad news? The bad news is that capital spending has exploded, and the industry is spending approximately $3.2 to $3.4 billion in capital spending this year. To put this into perspective, before the financial crisis, the industry averaged $1.2 billion per annum in capital spending. So in other words, in real terms, the industry is spending today 2 times what it was spending before the recession. And this is beginning to have an impact on same-store NOI, which has decelerated for the industry to the 4 to 5% rate. And that is before much of this capacity comes online. Given that the industry is enjoying very strong margins, there is no problem with borrowing against the facilities or borrowing to build a new facility today. So this strong capital spending can go on for a number of years until things get to the point that they deteriorate and the banks cut off credit. So we see self-storage as a microcosm for what we see going on in real estate. Things are good and is likely to see a slow deterioration as much of the significant amount of capacity that's in process comes online, whether for multifamily or whether it is for hotels or for office buildings. Real estate is a notoriously cyclical business, and typically capacity comes on at the tail end of an economic cycle. So let's talk about valuation. When we look at the valuation for real estate properties, let's talk about that. From 2014 to 2017, the public companies, and remember private transactions are usually at a discount to the public companies. So for the last 4 years, their price to FFO, or funds from operations multiple, has been between 14 and 20 and averages around 17 today. For the period from 2005 to 2010, it averaged 11 to 17 times. So, if we look at that from a multiple perspective, if we went from 17 times cash flow to 12 times cash flow, that would be more than a 30% drop. This is sort of what is likely to occur as interest rates normalize over the next 5 to 10 years. And the way someone should look at this for a property, let's say a self-storage property, is that if you have a property today that is valued at a 17 multiple, which is a pretty good rate, that would be like a 6% cap rate, more or less. If it is valued at that kind of multiple, however, if in the future that cap rate drifts up to, let's say, 8.5%, so at a 12 multiple, which is the midpoint of the old range from 2005 to 2010, the cap rate would be more like 8.5%. And historically, the cap rate between 2000 and 2010 ran between about 6% on the low side to 9% or more on the high side, depending on the exact category of real estate. But if that cap rate were to go back to 8.5%, it would put a significant dent in the value of a property. Even if that property compounded its NOI at 4% for the next decade and rose in value by 50%, the value of the property, due to the rise in the cap rate, would not go up much, and in fact would probably rise something like 10% over a decade, or less than 1% compound rate of return. If that were to happen and inflation were to average, let's say, 3% over the next decade, and by the way, that is not unreasonable because the long-term average of inflation over the last 100 years has been 3.2%. That includes some times when it's been very high and some times when it's been very low. But what we know is that the long term is 3.2, and if your property is only going up in value less than 1% over the next decade, then in real terms, the value of your property is shrinking. So, when you are thinking about your real estate, you cannot depend on the value of the property to inflate. If cap rates don't go up from here, that's because economic growth has disappointed, and as a result, your NOI growth is probably less than the 4% you're looking for. So what you need to think about in investing in real estate now is, can I take this property and fix it up in a way that I can increase the underlying cash flow in the property and increase its value today? Because I cannot depend on the overall valuation of real estate to go up over the next decade. And the one thing that we do know is that cap rates have already started to creep upward, and this creeping upward is likely to continue over the next couple of years. And that is all I have today, Dan. I hope that's of interest to your listeners.
Yeah, it definitely is, Paul. And I guess I sum it all up by, and I'm sure everybody's kind of already on this same page. It seems like all of our assets are overvalued, including the stock market. It just feels overvalued. It feels like the bubble is, in full swing and ready to burst at any moment. But, how long could these bubbles go on for? A year, 2 years, 3 years until interest rates and markets correct? My only question, Paul, was the Federal Reserve doing something for inflation. I'm going to assume that the Federal Reserve's action would be rate increases, right?
Yeah, that's the traditional way they have acted on inflation. If you go back and look historically, they've been increasing rates at a very slow rate for a rate hiking cycle. And what we would expect if inflation did accelerate And there's a lot of what we see as leading indicators of inflation that would indicate inflation would accelerate next year. Then the Fed would probably start to raise rates more quickly. Instead of raising them once every couple of quarters, they might start raising them every meeting, right? And that's the kind of thing that would happen. But we have to wait. There's an important thing we need to wait to see is who President Trump is going to appoint as the next head of the Federal Reserve, because that might impact how aggressive the Fed is in addressing inflation.
Paul, would you like to share your contact information and a little bit about your company for the listeners who may want to reach out and get in touch with you?
Sure, Dan. Thank you very much. Our company is Green Drake Advisors, and we do wealth management, which means we help guide our clients in making their important financial decisions so they make the right ones for the long term. We provide advice in both retirement planning, educational planning, investment advice in terms of actually making the investments. We also provide advice in estate areas and also in business succession. We can be reached via our website, www.greendrakeadvisors.com, or you can contact us at our offices at 610-687-7766.
All right, cool. Well, hey, Paul, I appreciate you taking your time out of your day to give us, this take on the economy. So I appreciate your time. Appreciate you coming on the show.
Well, thank you, Dan. I'm always glad to be here.
Thank you for listening to this episode of the Monthly Market Update episode of the REI Diamond Show. Are you interested in receiving an email notification when the next REI Diamond Show episode is released? You can either sign up at www.reidiamonds.com or subscribe through one of the podcasting apps, including iTunes, Google Play, and Stitcher. Do you have deals for sale? Go to www.reidiamonds.com and send them over. I am buying houses and other profitable real estate deals in the following markets: Philadelphia, New Jersey, Delaware, Maryland, Washington, D.C., Chicago, the Atlanta, Georgia region, and the Tampa Bay and Miami markets in Florida. You can also find deals that I might have for sale in those areas, along with our full catalog of past REI Diamond Show episodes. There is tons of cash-generating opportunity in the form of real estate and knowledge, which you can find there. Thank you again for being a loyal listener of the show. Dan Breslin here. I'll catch you next time.
Thank you for listening to this episode of the REI Diamonds Show with Dan Breslin. To receive email notifications of new weekly episodes, sign up at www.reidiamonds.com.